Welcome to the daily update. This is being prepared Friday, March 25th, where we'll look at the action in the market today and then see how things look for Monday, March 28th. And incidentally, if you've already seen the daily video, this is take 2. I recorded a video a while ago and I forgot to turn off a fan. And I didn't even notice it while I was recording. Well, when you go to listen to and I posted it on YouTube and I went back to listen to it and it sounds like a hurricane was hitting. So I decided to go ahead and re-record this video. So that's why some of you might be getting a different version of the video than usual. We had a pretty positive day on Friday. It was a bit of a roller coaster ride. We started out by being positive, only to go negative and then to bounce back. And then it looked like things were going to go negative again. And then we ended up having some buying coming in late during the session and things ended up being up on the day. So right at the open, we opened above R1. As the day went on, it looked like we were going higher and higher. And then all of a sudden, prices really declined pretty quickly. And the best that I could tell is that we were seeing yields, interest rates really rising. And there's a lot of program trading out there and they're looking over the entire market. And once they saw all of this, they started to get out of interest rates, or I'm sorry, get out of stocks and get into interest rates. They're trying to chase the return, basically. Well, we went all the way down to the daily pivot. We were able to bounce up off of that. We rebounded back up to R1. Well, then we saw a little bit more selling come in. That took us all the way down to the unchanged level. And then as we got closer to the close, there was some late day buying and we were able to get back to the intraday high that we set right after the open. We ended up closing at or right near the high for the session. We were up 0.51% on the day. And then this trend that we've been seeing all week of below average volume, not only that, but it's declining with each passing day. And I'll point that out in some of the charts. What we're fixated on right now are the technicals, as always, and they're pretty much positive overall. We're getting near the end of earnings season. The big concern with everybody right now is inflation and interest rates, as well as the different geopolitical concerns. So what are some comments that we can make? The S&P is still out of correction territory. The technicals are positive and improving as long as we have an up day. And even if we have a down day that's not too severe, the technicals will still continue to improve. We're just under the 100-day simple moving average right now. And I have some charts I'll show you about that. Prices still remain in a range. And if we continue to go higher from here, we're going to have to deal with that short-term double top that's a few weeks back now. And I'll point out what I'm talking about. Russia, Ukraine continue to be at the forefront of most news cycles right now. Sometimes we get a little bit of good news, sometimes it's bad news, but there's an awful lot of questions and a lot of information. We don't even know if we're being told the truth at some point. Sometimes it's true, sometimes it's not true. Of course, inflation is a real concern, not only from an investing standpoint, but also in a day in and day out situation. And then the China lockdowns continue, which is probably going to slow their economy down. And then how's that going to feed into the supply chain? We're already having trouble with that. We buy an awful lot of things from China. So is that going to cause even more problems with the supply chain? Consumer sentiment came out on Friday, and it shows it wasn't a big difference from the preliminary report that came out 2 weeks ago. It just shows that people aren't happy right now. They're concerned. They're worried about inflation. They might be worried about their own situation because every time they go to the store, they're seeing higher and higher prices. So this could be a real concern. And so overall, you're seeing more negativity right now. From a valuation standpoint, if you look at the S&P all by itself, it's overvalued. If you do more of an intramarket analysis, comparing it to the bond market, and to margin rates and things like that, we're more fairly valued at this point. The trend is positive, but weakening because we're coming off of having a pretty strong negative trend. As things shift with the ADX, we're seeing the ADX decline. On Friday, we had an up day, so the bias is positive, and then pretty much over the last week, even though we had some down days, momentum is also positive. So let's go back and look at the day's session. Looking at sentiment, we're getting more into the neutral area of things. Remember, we came off of showing pretty extreme fear. We bounced up out of that. People are feeling a little bit better when it comes to the stock market, and we're getting more into a neutral reading right now. This just shows the base that we started to come up out of. And as prices overall have been going higher, we're starting to wear off that extreme pessimism and we're getting back into neutral territory. The VIX also declined on Friday on a closing basis. And if you've been watching these videos for a length of time, as we were going lower, we saw a series of higher highs and higher lows with the VIX. Well, we're seeing just the opposite. Once the VIX spiked and we're going lower, now we're seeing lower highs and lower lows overall. Where we're going to start to get complacent is if we drop below 20. Right now, we're below the moving average, but this is just showing that not a lot of hedging is still taking place. But if we look over at the Vixen, we're seeing more sideways action. It's not really declining like the VIX is. The Ulcer Index is also declining and below the moving average, just showing that there's a decrease in fear in the market. One thing that I wanted to update in Friday's video, I didn't get the updated chart until now, is showing that the Ridex bear to bull ratio is declining. We're down at 0.04. So these spikes that we saw, yeah, they were real handy at the time and they really helped to show that we were bottoming out. But now we're getting back more to a bullish type of reading. Then this is the University of Michigan Consumer Sentiment, their final reading. It ticked down from like the high 59s into more the mid 59s here. But it's just showing this blue line. This means people overall are happier. And it's choppy because people are crazy and, you know, every day change with the wind. But in a real healthy environment, we want to see consumer sentiment climbing and interest rates climbing at the same time. We're not seeing that now. We're seeing people getting more pessimistic as interest rates are going up. So this is one of those battles. Somewhere something's going to win. Either something good is going to have to happen on a longer term basis to help people feel better, or we're going to see a decline in interest rates. Because this could go pretty extreme and for quite a while, but at some point, the scenario is going to have to change. Looking at our sectors, we were positive 9 out of the 11 on Friday, not by a lot. It wasn't a huge up day, but energy led the way at the top. And then the two sectors that were down weren't down very much. We had tech, which had been down a lot more, but still finished negative for the day. And then discretionary, which continues to be in last place in our sectors. It had, again, not a real significant down day, but was still negative. Here is how things look since the all-time high. Energy in first place. Discretionary is in last place. Communication actually slipped into last place during the week, but now discretionary is holding up the rear at this point. Then I want to keep an eye on the tech sector, especially because that's a real growth area. We're seeing prices really coming down overall, but then we've seen the rebound since we hit that low week before last. And we've been able to get just slightly above the moving average right now. Could we decline from here? Of course, but it is showing a little bit of an improvement. As far as inflation, The CRB was up 0.82% on Friday, and we're seeing a really strong uptrend overall. And this is what ultimately feeds over into inflation. These are the materials that are used. Well, if companies have to spend more to get these materials, they're ultimately going to feed through into the prices that we end up paying as a consumer. Then looking at aluminum, it was down on Friday, but is still spiking higher overall. Gas, this is what you're probably feeling the most. It was up 2% on Friday. It has been higher, but it's still continuing to be higher than it has been. Heating oil also, it declined over 1.33% on Friday, but is still quite high right now. And again, look at where we were when we started to spike before. This is into 2008, right? About the time we had the big financial meltdown. Same thing with wheat. About 25% of wheat is grown in either Russia or Ukraine. And because of the war situation there, we have been really spiking up with wheat. When's the last time we saw a spike up? 2008. Now, I'm not saying that we're going to have a financial meltdown necessarily. We have to look at the charts and then they will tell us what's happening. So just be aware of that. These are things just to be aware of in the background right now. Another chart that I haven't shown in a while is lumber. It's actually been declining. It was up a little bit on Friday, but after the whole COVID plunge and everything that happened, we really started to climb. We retraced, then we just skyrocketed up, fell back, and then we were climbing. Well, recently we've been showing a decrease in lumber prices. And then this is the fertilizer chart that comes out once a week. It just shows that things are really advancing. If farmers are having to pay more for fertilizer, that means they're going to have to charge more for what they produce. That means companies are paying more, and ultimately that will come through to us as the consumer. And we're still quite a ways away from FedWatch, but I just wanted to bring this up. Right now, it's showing that as of the Fed meeting coming up on May 4th, they expect interest rates to be at 0.75% to a full percent. That would be a 50 basis point move from where we're at right now. We're in this range. Now, this is going to change a lot between now and May 4th. I look at this every day, but I bring it up in the videos every so often just to kind of keep you in the loop with what's happening. Then to look at the historical values of and how they've changed over time. I don't pay a lot of attention until we get closer to the meeting. This is looking out to the June meeting, where right now at the end of that meeting, there's a 66% chance that we will be at 1.25 to 1.5. That's a full percentage point above where interest rates are at right now. And these are the low interest rates. This is where all the other interest rates are set: mortgages, loans, credit cards. And unfortunately, it doesn't really bleed over that much into savings accounts and CDs and things like that. But it sure does bleed over into the interest that you have to pay for borrowing money. And this will change quite a bit. I just want to keep an eye on this for right now. As far as our technical alerts on Friday, they were mostly positive. The NASDAQ first was able to get above 14.2, but then things declined and we went below 14.1. We did come back, but we never got back to the 14.2 level before things closed for the day. Tech had this is kind of interesting. First of all, it hit a bullish BPI cross above 80. Well, then when things declined, it slipped below 80. So that's an official signal. This is a two-part signal. First, we cross above 80, and then the overbought signal is then generated when we go back below 80. And then Canada has been showing a nice rebound as well. It got over 22,000. Intraday, let's go through and look at this. Here we gapped higher at the open, and then we saw a pretty nice climb. We got above R1, and it looked like, okay, all right, things are looking pretty good. And then boom, this is when I'm thinking that the market noticed interest rates were really going higher and higher, big time. And that led to some selling into the market. We came right down to the daily pivot. Isn't that interesting? We were able to bounce up off of that. Now the unchanged level was acting as resistance. And we fought along this for a while, but then we're able to break above that. We got back up to R1, and then we saw some more selling come in, but it looked like things were going to turn slightly negative. But about the last 20 to 30 minutes that the market was open, we saw some real buying coming into the market. And this is why I focus when I'm doing trend-based strategies. If I'm looking to initiate one, I do it as close to the close as possible. Because my gosh, if you got in at the open, your emotions are all over the place. Now, once you get into a position, you're kind of at the mercy of the market. But if you enter a position the right way, more often than not, what will happen afterwards will take care of itself. At least you're dealing from a place of offense instead of defense. And that's why in my personal strategy, I look to initiate anything new at the close. And when we did get to the close, we were just about able to get back to the high that was set right after the open. All right, here's the daily chart, looking a little more positive. On a closing basis, not only on the daily chart, but on a weekly basis, we were able to close above what had been resistance. That's pretty good. However, we still have resistance above where we're at. This is the double top that I'm talking about. We tried to bounce up, fell back. We tried to bounce through again. And then this is when we saw the pretty hefty decline. Can we get through this level if prices continue to go higher? That's kind of the question. And that's why I have this area shaded out right now. We're down 5.29% from the all-time high set back in January. And this is where things are after Friday's session. Growth saw a bit of a decline. Value saw a bit of an advance. Then comparing the two indexes, this is just showing how growth has really been declining. It has come back and been able to cross a declining moving average. That's positive. We need that to stay above this blue line for this blue line to turn back up. For it to get even more positive, we need it to climb back above the 200-day moving average, although the moving average is still going up. It takes a while for these things to turn. This is just an inverse of that same chart. We have value against growth. It shows that value has really been declining for much of 2022. Well, now it's falling back and has broken through the 50-period moving average. Then comparing the NASDAQ 100 to the S&P, this just shows that the NDX actually underperformed the S&P 500. A lot of the strength that we saw in Friday's session did not come from the real big tech stocks. It came from other stocks inside of the index. Then this is a new ETF that I'm starting to include here. It's not an ETF, it's an index. I wish it was an ETF because then we would have volume that we could look at along the bottom. But this is a pure value index. These are the things that people get into when they're concerned about the market and they think it's going to go down. Sometimes these value plays will actually advance or they don't decline as much as some of the growth stocks. So here and I'll start showing this on a daily basis where we are really advancing on a pure value basis. Now, looking at the growth index, this has been in a decline. We're below the 200-day moving average. We've been able to get back above the 50-period moving average, but overall, a lot of damage has been done to growth stocks. As far as our trend, here's the ADX. We are still declining overall. We have switched over positive with the green line on top and the red line declining, but the ADX is still picking up all this stuff from the recent history, and that was a negative trend. So if things continue to shift more positive, you can expect the ADX to fall. And if we go below 20, that's when we get into a more trendless environment. That's when you might want to look at doing more sideways or market neutral strategies. Then our Arun is actually looking more positive. It spiked up earlier in the week, fell back, and then spiked up again on Friday as we're seeing the red line decline. And we've actually seen a cross here. When these lines cross, that shifted the oscillator over to being positive, and it actually advanced a little bit on Friday. We're coming off of the Pring bottom fissure signal, and it looks like this is a valid signal. We set the base right here. This indicator crossed over, and we've been advancing ever since. Then looking at the decision point scorecard, there's really no changes. Short term is more positive. Intermediate term is neutral to negative, where the long term is still positive. Looking at breadth, we saw an improvement based on price. We also saw an improvement based on volume, but we're still below a declining moving average. The advanced decline ratio also advanced and is above 0. So that's more positive. The new highs and new lows, we set a lot of new highs on Friday, and the overall trend is positive. Then looking at the accumulation distribution, we're seeing some continued strength, but look at how this volume is really trailing off as we go day after day after day. That is a bit of a concern. Short term, we are well above the 20 period moving average. The 20 period moving average inside this study is showing that we're starting to get rather extreme, but we could go higher from here. Those stocks that are above their 50-day moving average is showing improvement, as well as those above their 200-day moving average. And then here's our moving average spaghetti chart, just showing that we're coming right up to the 100-day moving average. It's acting as overhead resistance right now. If we can see a close above that, that would turn things much more positive. And all of the moving averages that I plot on this chart, we now are above that on price. If that continues and we continue to go higher, we will see these moving averages start to turn up with more conviction. The MACD is positive. The STO is still negative. It's a crazy indicator sometimes. Based on price and volume, is showing a bit of a decline. The McClellan oscillator is giving us more of an extreme positive reading after falling back. Stoke RSI and then the one right after this, the Williams %R, they are pegged positive with both of these charts. Short term, we're looking a little overbought. The force index is positive and not necessarily extreme right now. Intermediate term, here's our 50 period moving average, and we're seeing a cross because the simple moving average calculates slower than the exponential, and that the simple is the blue line here. So that you could read some positive things into that. Here's our 100-day moving average, where we're just showing it as overhead resistance. The PMO is advancing, both based on price and volume and overall. The PMO study shows that those PMOs that are rising is starting to get extreme. Those that are giving buy signals is also starting to look a bit extreme, but those that are above 0 continue to advance. The BPI really didn't have a big change in the bullish percent index. We're just below this 70 level right now. So we're just behind showing an extreme reading, and overall we are positive. And then here's the longer term view of that chart. Our rainbow shows that we are hitting overhead resistance while we're trying to come back up into the rainbow itself. This is a little concerning too. Stochastics, short and intermediate term, are extreme positive, and we're getting extreme positive with even the slower stochastics or the full stochastics. The Sean trend meter, the only reason I'm showing this is we were kind of in this ugly yellow area for a while, where now we're coming back up into an ugly green area. Isn't that encouraging? And then our rate of change, looking back 10 periods, we had been positive. We wore that off. Well, now we're extreme positive again. The summation index is looking better based on price. It's advancing and may have a chance to go above zero. That would be even more positive. Based on volume, we have already crossed above zero and continue to advance. All of our momentum oscillators continue to be positive across the board. Our vortex is showing strength. That's the green line. And where selling is decreasing. So that's positive also. RSI is not giving us an extreme reading. We're above 50 and advancing. CCI, based on 14 periods, is giving us an extreme positive reading, as is the 20 period CCI. Our standard deviation fell a little bit on Friday, but is still getting pretty far away from this blue line. And then this can act like a magnet. It'll want to bring price back to it. So either the moving average has to go up higher, which it can take a long time for that to happen, or price is going to need to shift around so that we're not showing too big of a reading right now. The Chaikin oscillator, after giving us an extreme reading, wore that off and is still looking pretty positive. The Chaikin money flow, it's declining a little bit, but is still positive overall. And the percent B, after just touching on the upper end of the Bollinger Band, wore that off. And whoops, I don't know why this is popping up here. I'm trying to not hit that. I don't know what, and when Microsoft put this into Windows, it just, I don't want this here. Anyway, all right. And then the ultimate oscillator is starting to get into extreme positive territory. With our itchy cloud, we were able to break through the resistance here. Our different trading systems, Elder is positive with a green bar. SAR is positive with the dots underneath. Our different charts, the Heiken Ashi is showing a lot of white candles. So this is really showing some improvement. The Kegi chart is also looking more positive. Our Renko chart has a couple of open boxes right now. That's more positive. And the 3-line break has redrawn and is looking more positive as well. Equi-volume just shows that we're seeing a lot more green candles than red candles right now. The point and figure has not generated a new signal. The last signal that was generated is a double top breakout, but we're going to need to see this really advance to have that be a valid signal. Our Fibonacci, we are above the 38.2% retracement and starting to get a little bit behind that. We could fall back, but it would, if you're more positive on the market, you want to see this in the rear view mirror. Long term, we are above the 200-day moving average, both on the arithmetic chart and the logarithmic chart. And then our mega stocks, they were up virtually unchanged, but up a little bit on Friday. A lot of damage has been done. These are the real big tech names out there. And this is what a lot of you probably do a lot of different strategies in. And so if you want to continue with those strategies, you probably want to see these charts improve, unless you go both long and short. The special K continues to advance, and here's the longer term, but it's still below the moving average. Our moving average studies, our longer term moving averages, we're looking pretty healthy on the 50, the 150, and the 200-day. When we start to get concerned is when we hit some of these red areas. They start to show a pretty extreme reading. Broad market, the S&P is showing a really nice breakout. Mid caps, yeah, they're improving, but not showing as much of a breakout. Small caps are still, they're looking better, but they continue to be more sideways overall. FANG stocks were down 0.5%. They have been able to recapture a declining moving average, but there's still a lot of damage that has been done. Kathy did not have a good day. She was down 2.85% in the ARC fund right now. So came right back up to this moving average and has been declining since then. The Dow, this could be a big thing here because this green line is the 200-day moving average. And that's usually the line in the sand between a bull and bear market. If price can get above the 200-day moving average, things will turn back more positive. And the Dow is what, it's what the financial media looks at. It's what most people respond to when you say, how's the stock market doing? Well, they talk about the Dow, even though it's only 30 stocks instead of the 505 stocks that make up the S&P 500. Small caps, not showing as much strength. Now, if we really get some legs with the S&P 500 and even the Dow for that matter, we're going to want to see small caps really recoup that and bounce. Right now, they're not really doing that, even though it gave us a good signal when we saw this up period right here that led, and this happened right before the S&P shot up out of that base. Mid caps also dealing with a 200-day moving average. NASDAQ looking a little more positive as far as our bar chart is concerned, but we're still quite a ways away from the 200-day moving average. NASDAQ 100, kind of the same thing, was down a little bit on Friday, but we're seeing overall pretty good bar action right now, but we have the 200-day moving average above us, even though we've been able to get above the 50-period moving average. The Vixen, it's going more sideways right now, and even though we saw a little bit of a decline here, the NASDAQ 100 was not up that much, but the Vixen actually fell a little bit. NYSE looking more positive. This is broad-based now. We're above the 200-day moving average. That's pretty positive. Can we hold it is now the next question. And then the S&P 100, the biggest stocks in the S&P 500, they declined a little bit, but we're still above both of these moving averages overall. Wilshire, also more broad-based, still has the 200-day moving average ahead of or above current prices. Internationally, we're seeing a bit of a bounce across the board, including the S&P in the US. All stocks showing some real recent weakness, but trying to bounce back up out of that. And then these are all of the stocks outside of the US making this up. And I apologize, I showed this chart in Friday's video, but it was looking at 2016. It was back in this area. I forgot I had to go through and update the date range on that. But we're showing more of an overall downtrend right now. Looking at the broad market, the dollar was up on Friday and is looking pretty healthy. It may go in the toilet at some point, but today is not that day. And then here's the weekly chart. Also, we finished the weekly move right here, and it's looking pretty positive, both on a daily and weekly basis. Then oil, after spiking up over 130, fell back down under 100. Well, now we closed up at 113.90. Gold, and this is a lot of the different fake outs that are happening. People are telling me, I'm listening to podcasts and reading things saying, oh, gold's breaking out, it's breaking out. Well, whenever they say that, it starts breaking down instead. Again, some people that invest in gold, they don't care about the trend. They're interested in the tangible physical asset. But if you're trading things in the gold market based on trend, you're getting very frustrated with things. And the same thing is kind of true with the silver market. Here's the gold ETF. It spiked up and then fell back down, and it's just kind of chopping all over. But we are above both the 50 and 200-day moving averages. Here's a longer-term view of the gold ETF. Here's silver, again, breakout. Just kind of a spastic action right now. But we're coming off of a golden cross. Then here's just a longer term view of that same ETF. Bitcoin, after being in the low 30s, then it was in the low 40s. Well, now we're getting back up into the mid 40s for Bitcoin. Here's an intermarket analysis, just going back 1 year. just shows, my goodness, look at how oil has just been screaming higher. The S&P, after going lower, the black line, it's showing some improvement. Gold, keeps trying to break out and then ends up kind of letting a lot of people down. And then here's the dollar, which is the green line here. Where people are very disappointed is if you are investing in bonds based on price, because as prices fall, interest rates are really rising and they're really underperforming right now. Looking at the bond market, we're still seeing this decline in the yield. And I'm going to do some more research on this, because even if we cross below this, based on research that I did a while back, it does not necessarily mean that we're going to go into a recession. You have other people that are just, yeah, this is the ultimate indicator to tell us. Well, other people that I really respect and read, they say, no, the credit yield or the yield curve between the 10 and the 2, that's not what you should be looking at. You should be looking at the 10 and the Fed funds rate. And if you look at that chart, which I don't have here, because I want to do some more research first, it's actually going up right now. So, and even if we do go below this, see, we did drop below this in 2019. And then after that was a whole COVID mess. If this does drop below, it could be a serious lag time before something recessionary ends up actually happening. And if you're watching these videos every day, if you're really in tune to what's happening, there's lots of other things that we can also look at. And then our fib levels based on the 30-year yield is showing that we're breaking above 50%. We're at 2.6% right now. Looking at the 10-year, we've broken above the 61.8 retracement, and we're at 2.492%. I just shift the decimal over one place there. And we're just seeing pretty much across the board rise in interest rates, 30. And then you've got this tug of war going on between the 10 and the 5. Here's the 2-year yield. And then down here is the 3-month yield. And then here's internationally. We're just seeing a real spike in interest rates worldwide right now. Bonds based on price continue to fall. Okay, we're getting back down to some possible support. We broke through this support. Are we going to go down to this level of support? And then what's going to happen? If interest rates keep going up, is this going to keep falling even more than it already has? Then looking at corporate bonds, they were weaker on Friday, with the current yield being at 3.49%, the most recent that I could get. And here's just a longer term chart going back to the early 80s. Junk bonds tend to go more hand in hand with the markets. We've seen a real decline in junk bonds. Well, we saw a bit more of a decline on Friday. Relative studies. This is one that could be disappointing to a lot of folks, because it really looked like gold was breaking out compared to the S&P 500. So they got out of their SPY and got into GLD. Well, now they're kind of going, what in the world is happening right now? Because the gold is really falling back, as the S&P could possibly start to outperform gold. And then looking at energy against the SPY, energy is just skyrocketing and not even really looking back. We have some little down days here and there, but with everything that's happening in the world right now, energy prices, until something happens, it looks like they're just going to continue to go higher. Looking at growth against bonds. Now, bonds, growth has had trouble, but bonds have had even more trouble. So if you're in growth stocks against bonds, you've actually fared quite well. But both of these are really struggling in and of themselves. And looking at the tech sector against the SPY, tech has fallen back and is weak. If we want to get back to more of a growth type environment, we need this to cross back above the moving average and then have a look like we saw in 2019 into 2020. And then it started to go sideways more in 2021. Then looking at the tech sector against interest rates, as interest rates go up, tech stocks tend to go down. And that's why we saw a lot of the selling on Friday. As interest rates were spiking, the NASDAQ and even those tech parts of the S&P 500 saw a decline. Then looking at tech, the 10, this is just an inverse of this chart. It's just showing that interest rates have been in an overall uptrend, especially compared to tech. Then looking at the discretionary, the things you don't really have to have, they were trying to bounce back a little bit, but they've been in an overall downtrend when you compare them to staples, the things that people do have to have. And then looking at the S&P with interest rates, again, interest rates are just going down or going up big time. So we're seeing a real move down when compared to the S&P 500. And then this is the low volatility ETF. These are the stocks that people, or the ETF that people get into when they're a little more scared about what's happening. This is the standalone ETF. Now, when we compare the low volatility ETF with the SPY itself, we have seen a real decline as the SPY has really outperformed. Well, now we're seeing the lower volatility outperform, but we're seeing a bit of a pullback as well. So what's our outlook for Monday? We are still in correction territory. A lot of this I've said before. The market's still in an intermediate term range. If prices continue to advance, we're getting close to a double top. We're getting near the end of earnings season, but we're still there. The battle between growth and value just goes back and forth all the time. On Monday, we have retail inventories, advanced wholesale inventories, and the advanced good trades deficit being reported. In and of themselves, these are not really market mover type reports. They just help feed into our overall economic picture. And of course, we have the geopolitical events, Russia, Ukraine, that could change at any time, either for better or for worse. And then the situation in China with their lockdowns and how that may feed over into the supply chain issues. And then the NATO meetings have pretty much ended, and either the president is back in the US now or is on his way back. So our different scenarios, if we're looking at what could possibly make the market go down, it would be a reversion back to the previous trend before the Fed started raising interest rates. The prior trend was negative. Are we going to go back to that? Is the bounce that we're seeing right now just to wear off extreme pessimism? Well, that pessimism has gone away now, and we're still going higher. So to me, this is looking like a least likely scenario. It could still be there, but it's looking like it's not as probable right now. A more viable alternative to going down would be, yeah, we've risen pretty far, pretty fast. And so in the short term, we're overbought and hitting resistance. So if we see a pullback in prices, it might be because of these things, not that we're necessarily getting ready to jet lower after showing a real negative environment. Looking at the up scenario, we are coming out of a base. I think you can see that pretty clearly looking at the charts. Our oscillators are positive. Our moving averages are providing support if we start to fall back, but they're also providing resistance if we try to go higher. But we were able to exceed the previous high set earlier in the week that I was talking about. Then the least likely scenario right now to me is the sideways, but we have to keep an eye on that because the ADX is falling. And if it goes below 20 and below that moving average that I plot on there, and we start to see a slowdown in price movement, instead of seeing 1, 2, 3, 4, not 4, but 1, 2, 3% moves either to the upside or the downside, we see 0.25%, 0.5%, 0.75%. That's showing a real slowdown where we're more in a trendless environment at that point. And that's when you might want to look at implementing more sideways strategies. I know in non-volatile situations, you're not going to bring in as much if you're selling things, but do you want to sell something for a lot of money and then be in danger of that position breaking down? on you. So what's our conclusion? Overall, the S&P is positive, but is in a range. Short term, we are positive, but we're hitting some overbought levels in our indicators and as well as overhead resistance. Intermediate term, we are positive with the oscillators, but our moving averages and even some of our indicators are starting to provide some overhead resistance. And the moving averages, we have to get above, right now, we need to get above that 100-day simple moving average. Long term, as long as we stay above the 20-period simple moving average, the long-term trend will remain positive. So thank you very much. I hope you have a very pleasant weekend, and I will prepare the next daily video after Monday's session.